Good morning, ladies and gentlemen. Thanks for joining us on our last and final day of FSM ETFestival 2020. So for those who have missed previous days, we'll start off with a quick recap and a refresher by Mr. John Paul Wong, General Manager of FSM1.com. Then following this, we'll delve into two sectors we'd like to highlight with our very own equity analyst, Ms. Ferlin Tan, sharing about global financials and why it should not be overlooked, while Mr. Jimin Wong from Nikko Asset Management will talk about e-gaming and why they think it is the next best thing. So let us now go to our first presentation of the day. First up, we have Mr. John Paul Wong, General Manager of FSM1.com, to share his top takeaways from the ETFestival so far. John Paul, please.
Thank you, Sarah. And good morning to everybody who has joined us this morning. So it's the final day of our FSM ETFestival 2020. I hope you've enjoyed the presentations in the last 3 evenings, and today as well we have a couple of very interesting presentations, first from Ferlin on global financials and also from Jermaine from Nikko Asset Management on e-games. So for me, I'll just try to keep it short, just 2 key points for me today, and how I'm approaching this top takeaways angle. It's really looking at the questions that we have received in the last 3 evenings of the ETFestival from you, and just trying to have a common kind of topic in terms of the most commonly asked maybe concerns or questions that our investors have had so far. So I'll start now. So implication of a changing world on our portfolio. That's the first point. And I guess the reason why this question came up quite a bit from our investors is, on the first couple of nights, we talked quite a bit about the disruption brought about by COVID-19 and what this means for, businesses, for economies globally. And also, of course, on a very personal level, what it means for ourselves and also for our investment portfolios. And, as part of the discussion, then quite a bit of our topic was, focused on technology, was focused on digital economy. And I had this chart to show how the various equity markets have performed year to date so far to August, previously in my slide. So I thought maybe just to give some perspective, because the performance of the digital economy sector was very strong. We were looking at about 60% in my presentation on Wednesday night, and that of course is higher than most of the other equity markets. So today, I just thought that, to answer some of the questions from investors on, so is it a good time to buy, or should I be selling, taking profits from some of my investments, including digital economy and so on? I thought I'll just focus on one point here, which is from a research perspective, our analysts tend to look at a couple of key factors. So one of it is forward earnings growth for the equity markets when we look at stock markets. So forward earnings growth is essentially the expectation of how these markets will be, delivering earnings on a forward basis, meaning in future. And in this case, we're talking about, earnings growth for this year, but this year we're already in August. So I think the more meaningful kind of numbers we're talking about is for next year, 2021, and also, of course, the year after 2022. These earnings growth forecasts, of course, are constantly changing, because the analysts that are analyzing these markets are also updating these numbers. So, of course, there's been a lot of updates from the analysts on these markets this year, especially because of, the disruption brought about by COVID-19. And they probably realize that the numbers are going to turn out to be a lot more green than expected originally at the start of this year. So if you look at this chart from our research team that was turned out about a couple of months ago, there have been some changes, obviously, because the markets have also run up quite a bit in the last few weeks. But essentially, I think if you're looking at the forward earnings growth for 2021 and 2022, we're looking at strong growth from firstly the digital economy. So perhaps no surprise from investors who have been following our event for the last few days, because of the catalysts and the factors that are pushing these stock companies that are in this digital economy to keep delivering better results in terms of financials, and also their business model has obviously benefited significantly from the last few months. And if you look at the other stock markets from a maybe more regional perspective, you'll find a lot of red bars. Essentially, earnings growth is negative this year, and that's of course not a shock to us, to all our investors, perhaps because of the disruption brought about by COVID. Some markets are are seeing a little bit better earnings growth expectation this year. So if you look at China, for example, whether it's the shares market or the H shares market, the kind of earnings growth this year is essentially low or negative, but it's still much better than a lot of the other markets. And I think it kind of validates the thesis that China is actually in a pretty strong position among the major developed or developing economies of the world. So earnings growth, very important point. And also the last point I have on this slide is just to share that the second important factor that our analysts look at is when there's a huge rally in the markets, then the concern or the question we should have is, are the markets now expensive? So from a valuation perspective, sometimes we will be have price earnings ratios, price to book ratios, and those are signals to us as to whether the market has become too expensive. So even if a market has huge earnings growth potential, but if it has run up way ahead, then perhaps from a valuation perspective, it's no longer that attractive. And that brings me to the next slide, because a few questions that were asked the last few days were focused on the digital economy, because we at FSM1, we advocated putting digital economy into the core portion of the equities portfolio earlier this year because of the growing importance of the digital economy. I mean, our analysts, whether it's Rayburn or the June, they've been talking quite a bit about this, about the fact that the digital economy is now the third largest economy in the world if you classify it as an economy. So it's only smaller than China and the US, but larger than all the other economies of the world. And that shows the significance. And when we said, let's put the digital economy in the core portion of the equities portion of the portfolio, right? The neutral allocation that we had put back then was 10% earlier this year. And you'll probably be wondering then, then why is our current stance neutral? Because it seems like we are raving so much about the digital economy. So we are, of course, very excited about the long-term potential of digital economy. Having said that, based on the 2 points that I mentioned just now, the earnings growth potential is good. Having said that, the valuation is now quite high for the digital economy, right? So therefore, we're saying that keep it in the portfolio, but we're not saying go overweight, which is higher than 10% for the digital economy. We're just saying keep it neutral. So neutral is the same as the so-called 10% allocation that we have on the digital economy sector. So that's a bit of the perspective I just wanted to maybe share a little bit more this morning with our investors, because some investors were asking us, why are you therefore neutral? Then, if I made good money on digital economy this year, shouldn't I be selling it? So we're not saying you should be going 0% because it has run out. We're saying that from a portfolio perspective, if you're holding a few, that you're going to hold this portfolio for the next 2 to 3 years, keep it to 10%. So that's a bit of what I wanted to share. And of course, the other sectors within equities, and also on the other hand, within fixed income, please take a look at the slide in terms of the neutral weightings and also the latest weightings, which indicates whether you should be overweight or underweight or neutral. So this slide, essentially, from a portfolio perspective, we call it intra-asset allocation because we're talking about intra within fixed incomes. What are the subsectors? And also within equities, on the other hand, what are the subsectors? So that's the intra part. The next part is the broader inter-asset allocation perspective, which I shared on Wednesday night, and I won't dwell too much on this, but essentially, if I am a balanced investor or a moderately aggressive investor, it kind of gives me a certain perspective, on how much I should have between two very broad asset classes, firstly equities and secondly bonds. Essentially, I was also sharing that for one of the portfolios for my child's education, I'm looking at a profile that is closer to moderately aggressive, which is by right, based on neutral, it's 70% in equities and 30% in bonds. Currently, the allocation is we're having slightly higher in equities, which is 75%, and 25% in bonds for the moderately aggressive. So that tells us that we are still, overweight on equities versus bonds at this point of time, but we have actually reduced this overweight position and viewpoint that we have on equities just this month. And the simple reason is because equity markets have run up, and from a valuation perspective, it's getting a little bit expensive. So that's what we found earlier this month. Core and supplementary, I probably won't go too much into it, but we did get quite a number of questions from our investors as well. So within equities, firstly, when I'm talking about equities and bonds, right? So within equities, we're saying that, you can have, let's say, 80% in core and 20% in supplementary. And supplementary is really the tactical ideas, the kind of sectors that can really run up very fast, like we've seen in the last few months, like Chinese technology, for example, via ETF like CQQQ. But of course, from a risk perspective, it can also go down very fast as well if market sentiment turns against us. The second point I would like to take this morning, based on the feedback that we received the last few nights, right? It's just going back into some of the basic features of ETFs and how we can make use of these ETFs for our portfolios. So I think it's very clear, that if we want to build a global portfolio that is diversified, one very, very good instrument that is simple, that is transparent for us to understand, it's really ETFs. Here I just highlight three factors. One, it's easy to get started into an ETF. So whether we meet young investors, some of them still, studying, and from a capital investment perspective, for them, they want to start, let's say, from a smaller amount, obviously. So what we've done since the end of last year at FSM1 is to reduce or to kick off the RSP feature, the regular savings plan feature, from just $50 a month, so that it's a lot easier to get started to build a globally diversified portfolio. And we've also made the charges very competitive for RSPs. So, for example, it's a commission fee of 0.08%. So very similar to how you buy your stocks, right, and your ETFs normally. But for RSP, we have reduced the minimum fees. So depending on the exchange, whether it's SGX, US markets, or Hong Kong, so the minimum fees would vary, for example, $1 Sing, US dollar $1, or 5 Hong Kong dollars. So of course, if you're looking to just do your usual trades in stocks or ETFs, our usual charges will be 0.08% still, but subject to a minimum of $10 Sing, 880 US dollars, and 50 Hong Kong dollars. So easy to get started is one point. The second point, diversification. So, when you look at one ETF, it's made up of several individual securities. If you come to our website, fsm1.com, or if you go to download our FSM mobile app, you'll be able to find the top 25 holdings for the various ETFs that we carry. So well over 2,000 of them on the platform. And when we show you the top 25 holdings in each ETF, there's also an information that tells you how many percent it takes up in the portfolio. So it could be top 25 holdings takes up 40%, 50% of the entire ETF. So that gives you an idea of how concentrated the ETF can be. It's of course therefore less exposed to company-specific risks, because a portfolio of ETFs has quite a number of stocks. But if it's a bond ETF, then it has quite a number of bonds inside. So therefore, company-specific risks are reduced within ETF. And simply the last point that I've alluded to, it's just so easy to build a globally diversified portfolio, and it's important to do that. Ever more so, I would say, during these times like now, because the world is changing so drastically and rapidly. So in terms of having exposure to various global sectors that we think can do well in the very long term, so ETFs really can help us to achieve that. So the third point, accessibility, access to various markets and asset classes that may not be usually available to retail investors. So let me just run through these 3 points a little bit more. So first point, easy to get started and stay disciplined. I've talked a lot about the benefits of RSP, and the simple reason is because I do it every month without fail, whether it's for my own retirement plan or for my child education plan, like I've shared with you earlier, during the ETFestival. So for $50, you can start, and with time on your side, especially for younger investors, your portfolio has the ability to tide through the ups and downs in markets. So when markets go through big downturns, in a way, that there's time on your side, and time has shown in history that markets, even having gone through major crises like the GFC, let's say about 10, 12 years ago, markets do pick up, and sometimes they can pick up quite fast. And I think one very good example would be, markets picking up from the depths that we've seen in March this year. So the discipline part is something that I really like about RSPs, because it just forces me to invest every month. And I know that I'll be buying sometimes at the higher price when markets are going up, but also if they are going down, I'm also dollar cost averaging down. My so-called weighted average cost of my investment. So that's a good thing in the longer term. Emotional behavior is reduced, and it seems like a mundane point, but it's such an important point because I think a lot of us, whether it's my friends, my family members, or even professional investors, emotional investing affects basically almost every one of us in terms of what we should be doing, and that's something that we have to avoid or keep to a minimum. And an RSP allows us to do just that. Because if I'm worried about markets going down in March and I sold off, I would have missed the subsequent rally. But if I had stuck to an RSP, I'm still invested essentially, and I will be participating in the rally in the last 4 months. And of course, the power of compounding, just adding in the investment that I'm putting in, and of course, if you're a dividend focused kind of investor, you're the kind of investor looking for income, then of course, having the dividends could also help with the power of compounding if you're investing it. So the next point, diversified and easy to diversify. So firstly, diversified because of the ETF structure and nature itself, and easy to diversify because it's so easy to have access to all these different sectors. So just as an example that my analyst shared, Hui shared this. So in terms of the core and the supplementary and the various constituents inside these two portfolios. So if you look at core, we're talking about the major regional markets, right? Like US, Europe, Asia, Japan, and I shared about having digital economy as well inside. Japan would also be another example of a core regional market. So if you're having 90%, let's say, in equities and 10% in bonds, so you're a bit of a more aggressive kind of investor. So 10% could be in the form of a Singapore corporate bond. So that's one sample, an example for you to consider. So the supplementary part will be the tactical ideas where you keep it to about, let's say, 20% of your overall portfolio within equities. So as a percentage of the total portfolio, it's roughly about 18%. So here we have the examples of semiconductors, a sector that we have liked for quite a while, and also Chinese technology as well as Asian REITs. I talked about the third point just now, accessibility. So, if you're an investor who have been following, the development of some of these tech giants coming from not just the US, but especially from China, and if you like Tencent in this example, it's actually quite a huge capital outlay to buy Tencent on the Hong Kong exchange. So we're talking about a lot size of 100, for example, right? That's going to cost about $9,000. But with an ETF, which has Tencent in the top holdings, and you can check out the various ETFs like ODEEC, for example, which will show you how much Tencent takes up in the portfolio. Then it's a much easier access, to having a portfolio with the names like Tencent inside. The other part of about accessibility, it's really about having exposure to very niche sectors, very tactical sectors that otherwise would have been quite difficult for us to have access to invest into. So Jun yesterday talked about cloud computing, for example. So that's something that is easily accessible by an ETF, from First Trust. Or even for investors who've been investing in REITs and they're wanting to, let's say, build up the income aspects of having the REITs in their portfolio. Having a diversified portfolio like the Asian REITs from Nikko would also help. China shares, another example I would say of having access to the Chinese shares listed on the Hang Seng. So with a Hang Seng China Enterprise kind of index, you can also have access to the various banks, the various tech companies on the Hang Seng. And there will be changes if some of the news that's been coming out on the composition of Hang Seng. So indices do change, so it's important to keep a look on how they change. So sometimes they include new constituents, they take out the older ones, and I think the Hang Seng has plans for that quite soon. We could be sharing more information about some of these changes every now and then from our research point of view. So I'll wrap up here. I think for the ETF festival, first time we organized it last year in Singapore. I think it was the very first ETF focused kind of event in Singapore, and we're happy to actually have our investors last year at the physical event at at City Hall. Times have changed so much, in the last 1 year. We've done ETF festival for a second time this year, but entirely via webinars. And one very key change and comforting change for us, very encouraging sign to us, is the sheer size in terms of number of investors joining us the last few days and today, and sharing their experiences and also asking many questions to us and our speakers. And we will be keeping an eye on these questions even after this event, in terms of trying to just come up with some of the answers. We couldn't answer everything because we were frankly quite overwhelmed by the responses, and we thank you for that. I also wanted to just add that in July this year we have added the CPFOA and SRS payment methods for SGX listed ETFs and stocks. So if you have some money in the CPFOA account and SRS account, and you would like to invest in some stocks or ETFs that are SGX listed, like let's say the Asian REITs from Nikko, so you can actually do so with us since last month. And of course, our research team, you've heard a few of them. The last few days, you'll be hearing from Ferlin later. They are constantly looking at new ideas, writing updates on the previous ideas that they've shared with you. So regular new ideas on our website and mobile app. Keep a lookout. They're constantly writing new things, new updates in terms of how that can help our portfolios. So thank you so much for your support. That's my last slide. We've been around FSM1 for 20 years. This is our 20th year anniversary. A lot of new things have happened in the last few months. We also launched a new mobile app in July, just last month. We're really excited about how this app can help you in your investment journey. I've been sharing, a few days ago, how I've been using a lot more of the app practically every day. So if you're interested to, just track the markets, if you're interested to start your ETF RSPs, if you're interested to change the amounts in your ETF RSPs, it's so much easier and seamless for you to do it on the mobile app. So if you haven't downloaded the app yet, please do so, and just let us know how's your experience in terms of using it. We're happy to take your feedback. So thank you so much for your time. I'll now pass on to Ferlin, who will be talking about the global financials.
All right, thanks, JP. So for our next presentation, we are putting the focus on the global financial sector and why it should not be overlooked by investors. So despite the financial sector being ravaged by the pandemic this year and ongoing persistence of short-term risks, the sector remains at the heart of every economy. So here from Ms. Ferlin Tan, equity analyst with IFA's research team, as she shares why we believe global financials is a good value play for investors who are willing to take a longer-term view and are able to stomach wild swings in the market. So Ferlin, please.
Very good morning. This is Ferlin. I'm from the FSM1 Stock and ETF Research Team. So once again, thank you so much for tuning in to our webinar this morning. And today is the final day of our ETFestival 2020. And I really hope everyone enjoyed all the presentations we had over the last couple of days. So as you have read from the synopsis, I am here today to share our views on the financial sector. So I know everyone is probably hesitant when it comes to the financial sector, for good reasons, of course, like how the financial sector is generally facing all sorts of headwinds from many different angles. But before I continue, maybe let's kickstart this session by trying to understand what happened to the financial sector over the last few months. So roughly around February, many countries started to shut down their economy to tackle the outbreak of COVID-19. So most of the malls, restaurants, and factories were all closed. Travel bans were imposed as well, and all these brought much of the global's economic activity to a halt. And this was followed by rate cuts to almost zero by the central banks across the world, and all these were done in hopes that it will stimulate the economy. And as a result, the global financials suffered a sell-off, dropping about 40% from their peak, because investors generally anticipated that these measures to curb the COVID-19 situation will weigh on the financials' profitability. And at this point, I think there is no need for us to sugarcoat the impact of COVID-19 on the financial sector. So this economic downturn is expected to set off waves of defaults, as many companies that are affected are likely to face difficulties servicing their loans, especially those that are very reliant on their monthly operating cash flow to repay for their liabilities. And in anticipation of these defaults, almost all the banks have set aside large provision for credit losses for this year, and this took a huge bite out of their profits. Secondly, low interest rate environment also means low interest margins for the banks, for the insurance company, and also other FIs that generally rely on net interest income. So social distancing measures implemented will also mean lower premiums sold by the insurance company for this year, because number one, agents can't meet their clients, and number two, property and casualty insurance demand is dampened since demand for traveling, for houses and cars are all falling. So finally, when even though there are bright spots, we should be aware that firms like asset management companies, they earn primarily based on asset under management, which is directly correlated with the market valuation of the financial assets. And this is something that doesn't bode well with them in the event of a market sell-off. So yeah, I'm quite sure majority of us now understand that financials are indeed not in the best situation. So the big question here today is, are financial stocks still a good value play? But to answer this question, let us first give a very quick commentary on what makes up the financial sector. So first of all, as we know, financial institutions play a very important role in an economy by mobilizing funds and providing liquidity in a form of loans, deposits, and investments. So look around you and you'll realize that everyone living in an economy has probably established a relationship with at least one financial institution. So almost all businesses will also require financial services at some point in time, be it for loans, for insurance, or just simple financial transactions. So as such, it is very clear that the financial sector is highly interconnected with everyone and everything. And it's safe to say that no economy can advance without a strong financial system, underscoring the systemic importance of financial institutions in our world today. So what exactly makes up the financial sector? Based on the JICS classification, we have broken down the sector into three industries. Number one, the banking industry. Number two, the insurance industry, and other diversified financials. So we are probably most familiar with the banking industry, which refers to the financial intermediaries that connect savers and borrowers. So what they do is that they will take in deposits from customers like us and pay us interest in return. They will then channel these funds to borrowers as loans, on which they charge an interest higher than what they have to pay to us. So this is usually the core business of a typical bank. Next, there are also the insurance companies, which offer risk management products to their customers and collect premiums from them in return. So the premiums collected from their customers will primarily be placed in low-risk investments, such as fixed income instruments, which will help the insurance companies to earn the spread between their investment return and what they have to pay out as benefits to the insured. So the insurance companies can be viewed as large investors in the financial markets, and at the same time, they also ensure the financial stability of individuals and corporates by insuring their risk. And finally, we also have the diversified financials, which generally refers to a range of companies that offer a wide variety of financial products and services. So a few examples in this industry would be the investment banks, the asset management firms, brokerages, consumer finance, and etc. So now with a better understanding of the financial sector, let us go through why we believe financial stocks are a good value play right now. So at this current juncture, we know that financial sectors have yet to recover together with the broader market and is currently trading at attractive valuations. So the biggest concern to everyone is whether the financial sector is able to tide through this crisis to deem it as a value play. Now first, when it comes to the financials, you should be aware that the banks make up almost half of the entire financial sector. So naturally, we will have to look at the bank's financial status to determine whether the financial sector is able to tide through this crisis. So first, when it comes, so in the first half of 2020, many banks doubled or even tripled their provision for credit losses in anticipation of a surge in loan defaults. And this eventually led to a fall in capital levels and capital ratios. Most banks are also likely to register another 2 quarters of high provisions, although it could be at a slower pace, but this 2 more quarters of high provision will still lead to further reduction in the bank's capital position. And now the question in mind would probably be, so why am I talking so much about the capital levels and why does the capital position of the banks matter so much? So the reason is simply because the respective capital level of a bank is an indicator of whether they have enough cushion to absorb losses and still meet their financial obligation. So in the event that a bank that does not have sufficient capital in times of crisis, it will eventually lead to either insolvency, like the case of Lehman Brothers in 2008, or desperate capital raising activities, which will lead to share dilution, as in the case of Citigroup back in 2008 as well. So while there are indeed similarities between the current COVID-19 crisis and the global financial crisis, such as higher credit costs and net interest margin compression. But the big difference here is that the banks today are currently in a much better position than they were in 2008. So on hindsight, the failure of the banking industry was largely due to poor risk management. And if we look back, you can actually observe that their capital ratios actually went as low as 2 to 3%. But if we look at their capital positions today, you will see that they have built up stronger balance sheets over the years, which put them in a much better position to absorb a shock in the market. So in other words, the banks are very well capitalized to weather through the uncertainties in the market. And this is actually one of the pillars for our current call for the financial sector. So they were sold off because of all the headwinds they are facing. But once the storm is over, we see potential re-ratings in the bank's valuations as the economy normalized and they return to their pre-crisis level. So in the near term, I think it's safe to say that the financials profitability will be affected for all the reasons stated earlier. However, we believe you should take a longer term view for this sector and take the opportunity to scoop up some shares given their current valuations. Besides, we also see several long-term tailwinds that will benefit the entire sector, namely the growing middle class population, digitalization, and the recovery of interest rates. So number one, the growing middle class population across the globe. By 2030, it is forecasted that the global middle class population will increase from roughly 3.7 billion in 2020 to approximately 5.4 billion. So this is an important milestone given how a growing middle class population generally bodes well for the entire financial sector. So for instance, an increasing number of wealthy individuals will spur demand for wealth management products. So this is because these wealthy individuals are constantly looking for more avenues to park and grow their assets, which is a trend that the asset and wealth management industry can capitalize on. And similarly, a growing middle class population is also favorable for the banks, given how consumerism usually rises in tandem with wealth. So as people's disposable income increases, retail sales and purchase of big ticket items will grow as well, which will support loan expansion and cut fees. And besides, as their living standards improve, demand for better medical care and wealth protection needs increases as well. So this will spur demand for the long-term insurance products that will protect and help plan for their future wealth needs, benefiting the insurance industry. So from all these examples, you can generally see how rising wealth will be good for the entire financial sector. And secondly, we also believe that the adoption of digital technology will bring about many benefits in terms of cost savings and revenue growth for the financial sectors too. So as we know, digital technology has revolutionized the way we live and has become an indispensable part of our everyday life. And the adoption of such technology is no longer just an option for businesses, including the financial sector, to stick to their traditional ways. So firstly, majority of the large financial institutions in our society today have been around for decades, and most of them are still using their old legacy IT system, which can be time-consuming and expensive. So by migrating to digital platforms, financial institutions can leverage on new technologies like automation, artificial intelligence, cloud solutions, etc. So all of which will help to improve efficiency and reduce overall operating costs. So that's why you have probably read news on how the traditional FI like JP Morgan or local banks like DBS have been pumping in money into technology in hopes to improve efficiency and cut down on costs. So on top of that, technology will also allow financial institutions to enhance their ability to collect and analyze information. So generally, this can help to create more targeted marketing or cross-selling opportunities which can boost customer conversion rates and ultimately improve revenue growth. So all of which will help to boost the financials bottom line. And finally, we believe that eventual recovery interest rates will be a potential catalyst for the financials too. So using the Fed Fund rate as an indicator, I think it's safe to say that interest rates across the globe is at an all-time low. And while we acknowledge that low interest rates will likely persist, we believe an eventual recovery in the global economy could signal a start of the recovery in interest rates. Currently, consensus estimates that interest rate hikes will only start kicking in late 2022 to early 2023. So rate hike is correlated to net interest income, which is a segment where most banks and some other diversified financials depend on for profits. So naturally, high interest rates will lead to higher net interest margins and net interest income. Besides, rate hikes will also be positive for insurance company because higher interest rates will translate to higher yield earned on their investment portfolio, which also has a direct impact on the insurer's profitability. So therefore, as the economy normalizes and starts showing signs of a sustained economic recovery, this could signal a recovery in interest rates, which should spur a recovery in the valuations of the global financial sector, making them a good value play right now. So overall, as the heart of our economy, we believe that investors should not exclude the financial sector from their portfolio. And because valuation matters, we believe they are currently trading at attractive valuations, and investors who are patient enough to sit through this economic downturn will eventually be rewarded. We adopted a fair PB ratio methodology, which translates to an upside potential of approximately 29.8% by 2022. So note that the financial sector is also a good yield play as well, which is currently offering a decent yield of 4.2%, giving investors like us some treats while we wait for our share prices to re-rate. And of course, not forgetting the investment tool to gain exposure to this value play. So to take part in the growth of the global financial sector, our preferred choice of ETF is the Ishares Global Financials ETF with the ticker code IXG. So we have chosen this ETF based on our ETF selection methodology, which my colleague Ishares has probably shared on the first day of the ETFestival. So this ETF has one of the best liquidity. It has very decent expense ratio and tracking difference, which are our main selection criteria when it comes to picking the best ETF. So now moving on. Besides the traditional financial institutions as a value play, we would like to share a second financials related ETF idea that could be viewed as a growth play. So first of all, as we are aware, the financial ecosystem is made up of a wide range of companies that provide many different types of financial services for consumers like us on a daily basis. So previously, we have highlighted how digitalization and adoption of new technologies will be one of the major tailwinds of the financial sectors in the long term, given the convenience and efficiency it can bring to us. So indeed, the world is going through a new technological revolution as rapid digital transformation happens across all industries and sectors. So therefore, as the world evolves and starts adopting these new modern technologies, we see great opportunity in one very important sub-industry in the financial services ecosystem, which is none other than the payment industry. So from an industry level perspective, we see three growth drivers that will benefit the payments industry as a whole. Number one is the digitalization of consumption, which is something that we have been emphasizing for a long time. We also see further room for growth for cashless payment transactions, which will benefit the payment companies. And finally, in today's digital era, it only seems natural for companies and even governments to push for digital payment methods for all the benefits it can bring to them. So just to reiterate again, digital technology has revolutionized the way we consume information, entertainment, goods and services. And it has in fact become an indispensable part of our everyday life. On top of that, the COVID-19 pandemic has further accelerated the adoption of digital technology across many sellers, even forcing the traditional ones to move business to online in order to survive. So more than just young adults have moved to e-commerce, and we believe that this fundamental shift in our behavior is here to stay, and they will most probably become the next normal of our day-to-day lives. So in other words, we are going to witness a higher e-commerce adoption rate, or better yet, higher international e-commerce adoption rate. And clearly, there is a huge growth opportunity within the e-commerce space, which ultimately means that there will be a surge in demand for online payment systems, because for businesses and services to go remote, payments will have to happen remotely as well. So from here, you can see how the payment companies will benefit from this shift in consumer behavior. Next, there is also still a lot of room for growth for cashless payment transactions. So number one is through the increasing smartphone and internet adoption rate. So with the rapidly increasing global economy, smartphones have become an essential commodity for an individual. Similarly, the internet has also become part and parcel of life for many of us. So unsurprisingly, we're observing how this phenomenon is playing out in developing countries like India, Vietnam, Indonesia, and China, where we see an increasing smartphone penetration rate over the last few years. Besides that, you can also see that there remains a gap between the smartphone penetration rates between the developed markets versus these fast-growing developing economies, suggesting further room for growth in the global smartphone penetration rate. So what this means is that there will be an increasing number of smartphone users across the world. And as a bit smartphone users, I don't think I have to explain how reliant we are on our smartphones these days. So it's so convenient that I think we have reached a point where we can forget our wallets and continue on our day. But if we have left our phones at home, we'll probably have to turn back and retrieve it. So from here, you can see how reliant we are on our smartphones. And we believe this is the way forward in every market, where eventually we will do almost everything through this device if possible. So the world is literally in our hands now, and everyone will be so comfortable with technology. And once again, we will conduct most activities on our smartphones. So eventually, in terms of consumptions, this would mean that more consumers will transit from physical retail to online e-commerce, which will drive the growth of digital payment market for reasons explained earlier. So adopting mobile phone is step one, but you'll be surprised to know that there are still many markets that are relying heavily on cash usage, which can be viewed as an opportunity for online payments companies to step in and gain market share as well. So obviously, the developing markets are still relying heavily on cash, but surprisingly, some of the largest developed markets have yet to transit from cash to cashless payment modes. So as a developed market, Europe has one of the lowest online payment adoption rate, with 79% of all their transactions still carried out using cash. Japan too, with only around 18% of their payments are done through cashless modes. But what is exciting for the payment companies is that almost all markets have the same goal to increase cashless payments. So for China, we know most of their citizens use digital online payment system, but there is still a huge pool of opportunities where payment companies can tap into, especially in the rural areas where the payment infrastructure may not be as solid as the one in the larger cities. So overall, I think there is still plenty of room for growth for the payment companies, given the increasing smartphone and internet adoption rate across the world. Plus, given how economies are all moving towards the same goal of a cashless society, I think this will definitely be another plus point for the payment companies. And don't forget how COVID-19 has further accelerated the shift towards digital payments, since cash is viewed as the less sanitary payment method. So all these trends will eventually translate to strong users base and hence earnings growth for the payment companies. And finally, in today's modern digital world, everything is about data. Therefore, we are seeing a lot of governments across the globe pushing for a higher adoption rate of digital payment system. So the reason behind this move is that by having digital footprints for all transactions, such a move will deter crime, money laundering, and tax evasion significantly. So therefore, we see many countries, especially the emerging economies, have started to leverage on digital technologies to push for a digital payment system. So India created the Unified Payment Interface, which is a national digital payment infrastructure designed to facilitate transferring of funds between banks' accounts on a mobile platform. So you'll probably remember in 2016, India also withdrew all high denomination banknotes from circulation, which is a move to push its citizens to adopt digital payments. And it was also found out that in Argentina, participants who admitted to paying bribes to local officials fell from 3.6% to 0.3% after the government moved to electronic payment methods. So these are a few good examples to show how government has been pushing their own respective country to adopt digital payments to deter crimes. And besides, as more consumers adopt digital payment, this will also help enhance security for customers as well. So for instance, PayPal processes approximately 27 million transactions a day, collecting pools of data about its customers' spending patterns, behavior, location, and more. So this data is used to verify customers' identities implicitly, which also give the users the promise of security while saving time for them. And on the other hand, digital payment will also enhance security for merchants as compared to them keeping cash in their cash register. So from the merchant's point of view, payment data will also allow them to analyze shoppers' needs and wants, which will help to grow their business. So clearly you can see that how by going cashless, it can bring about many benefits to almost all related parties through all the data collected. So this means that the adoption rate of digital payment system should continue to grow moving forward. So overall, the thing about the digital payment ecosystem is that it has a network effect. When there are more consumers adopting digital payment methods, this will push for more merchants to adopt digital payment systems as well. So basically, the more users the payment ecosystem gains, the more valuable the services become. And we believe that this will eventually reach a tipping point where it actually becomes so hard for people to be excluded and stay outside of this ecosystem, which makes the entire digital payment system an essential service in our modern world. So therefore, if you're looking to capitalize on the shift from physical cash transactions to digital electronic systems, our preferred choice for this industry is the ETFMG Prime Mobile Payments ETF with the ticker code iPay. So it's the same we use based on our selection methodology. So this ETF has the best liquidity and tracking difference, which we believe more than make up for a slightly higher expense ratio. And based on our fair PE, we see an upside potential of 22.9% by 2022. But because given the importance of their services, we believe there will be strong potential growth in the years ahead as countries across the globe shift towards a cashless society, making this ETF a good long-term investment that you can consider to hold on to. So to sum up, here's our ETFestival 2020 two financials related ideas that we believe investors can capitalize on for the next couple of years. So if you're a beginner investor and you don't know where to start your investment journey, or you're an investor who's unsure of when to enter the market, we believe that you can consider engaging in our ETF RSP program, which enables you to deploy money into the selected ETF every month. However, do note that the iPay ETF is currently not available in our RSP list, but you may still consider doing it yourself and deploy money consistently on a monthly basis as if you're on an RSP program. So for more information on our ETF RSP program or ETF focus list, feel free to check out our page through this link on the screen. And with that, I have come to the end of my presentation. Thank you so much for tuning in on a Saturday morning. Thank you.
Thanks, Verlin. So next we have Nikko Asset Management to share with us why they think e-gaming is the next big thing, and also insights into Nikko AM eGames Active ETF. So we'll be pasting the link in the chat function later for your reference. The eGames industry's total revenue exceeded $150 billion in 2019, surpassing combined revenues of the movie and music industry. So this trend is set to continue and presents an investment opportunity with huge potential. So let us hear from Mr. Jimin Wong, Head of Asia ETF Business Development and Product Development Director at Nikko Asset Management Asia Limited. Jimin, please.
Thank you, Sarah, for the introduction. Good morning, everyone. I believe you can hear me. Please let me know if you cannot. My name is Jimin Wong. I am the Head of Asia ETF Business Development at Nikko Asset Management. To start off, I'll just do a really quick introduction of Nikko Asset Management. We are one of Asia's largest asset managers, currently managing total assets under management of about over $200 billion US. This includes AUM in both our active funds as well as our passive ETFs. Amongst the total AUM that my company manages, about a third of it are in ETFs. We are one of the largest ETF issuers in the world, top 10, very big in Japan. We are the leading ETF provider in Singapore. We are no stranger to managing ETFs. In fact, we have won many different ETF awards over the years. We have been managing passive funds since 1986. We've been managing the first bond ETF in Singapore since 2005. Nikko AM today manages 6 ETFs across Singapore and Hong Kong. I've been with the firm for almost 7 years now and have been partly responsible for the launch of 2 ETFs in Singapore and recently 2 ETFs in Hong Kong. And personally, I have never been so excited to share with investors about this particular sector in e-games, as I am of the view that this is a sector with great growth potential and presents a very compelling investment opportunity, which of course I will share more with everyone soon. Investing in e-games really is a type of thematic investing. When we think of ETFs, generally we think of major asset classes. When we think of Singapore equities, there's the STI ETF. Singapore bonds, there's the ABF ETF. Well, there's the S&P 500, the Hang Seng, the A50, etc. But today, as JP has shared earlier, and of course Ferlin as well, there are a lot more ETFs in the world that allows investors to invest in a particular sector, not just a particular country, but also a particular sector. Biomedical, internet, cybersecurity, e-games, digitization, healthcare, 5G, even marijuana. and of late, I've seen ETFs with a COVID theme or a stay-at-home theme ETFs. So this form of thematic investing allows investors to capture growth in specific trends and structural changes in our society today. So if you like a particular sector, there's probably a suitable ETF for you to gain exposure to this sector. And FSM does this very, very well in their select list of ETFs. So just to give you a sense of how thematic ETFs can perhaps help to complement your portfolio, let's take a look at this chart. So here I have charted out the index performance since 1988 to 2020 of some of the major indices like S&P 500, which is the dark blue line over here, the STI, which is the green line. And you see that there has been growth, and it is very important, in my view, to have these major asset classes, what I would call major asset classes, in your portfolio. But at the same time, if you like a particular sector, for example, the tech sector, the internet sector, which is the line in red, or what I'm going to talk about today, the global video game sector, the line in light blue, there can be a lot better performance over the long term. So it is important, I think, to have such thematic investing, thematic exposure inside your overall portfolio. Now let me move on to the main topic for today, which is e-games. Well, when we think about games, for different people of different cultures and different ages, different things come to mind. In the olden day, we used to play with stones. In Singapore, especially 5 stones, hopscotch, and I think those who are a little older would know what I'm talking about. We used to play chess and checkers, board games. And then came about technology, and we had video games. I'm sure many of us would remember Super Mario, Pac-Man, pinball, Tetris, and then PC games. Some famous PC games would include Command and Conquer, Civilization, Heroes of Might and Magic, Final Fantasy, Warcraft, and the list goes on and on. And today, we are almost all playing some form of mobile game. I am certain that at least 50% of you tuning in today have played some form of mobile game, maybe Candy Crush or Clash of Clans or Battle Royale. And what's also becoming very popular, it's virtual reality games and augmented reality games like Pokemon Go. And these are becoming gradually more and more mainstream. And the point here is that gaming has evolved. And as games evolve, businesses and business models evolve, and so should investors. Let me show you some stats on the e-games market. So since 2012, global gaming e-games revenue has grown leaps and bounds. In 2012, revenue was 70 billion. This column on the extreme left-hand side. In 2019, revenue was over 150 billion. It had more than doubled in the past 7 years. And in the past, 7 years ago, mobile gaming, this dark blue, formed 18% of the overall gaming market. PC games were 37%, and console games, your PlayStation, your Nintendos, were at 45%. Fast forward 7 years, console games and PC games have gone down from 45% to 24% and 37% to 22% respectively. And of course, mobile gaming has grown from 18% to 54%. Now, does this mean that actually PC games and console games have shrunk in revenue? That is not the case. While it has formed a smaller proportion, the truth is we have still seen from PC games and console games a compounded annual growth rate of 11% over those 7 years. It is just that mobile gaming has grown so much so quickly and has now takes a 54% proportion of the overall e-games market. The compounded annual growth rate of mobile games over that time period was close to 27%. Now, this is of course due to developments in mobile technology. As Ferlin said, the world is literally in our hands today. Better phones, better graphics, better internet connectivity. Many games, mobile games especially, are also designed to be more casual. It doesn't take too much of the time, but yet probably most of these games have got some feature to lure you in to play at least a few minutes a day, every day. Those who play mobile games, you would know what I'm talking about. And of course, also from a commercial perspective, there are more monetizing opportunities, advertising revenue, in-game purchases. And all of this monetizing opportunities leads to more incentive for game developers to come up with new games. And that really is what has contributed to the huge growth in mobile gaming over the past many years. So as technology continues to improve, which I have no doubt it will for sure, it is likely that the game sector will also continue to evolve and grow. Let me take everyone back 50 years, a blast to the past, when Apollo 11 touched down in the Sea of Tranquility on the moon on 20th of July, 1969. It was a momentous event, a breakthrough in human history, but it was also the story of a technology wonder called the Apollo Guidance Computer. This very unimpressive looking gadget that you see here on the right-hand side. But this was the gadget that helped astronauts safely navigate to the moon and back. And to put things in perspective, our phones today is a rough 66,000 times faster than this Apollo guidance computer. Just take a moment to process that. That's how fast technology has grown and how much technology has improved over the years. And of course, with it, human behavior and the way we game. And as we study more into this evolution, what we realize is that gaming is addictive. Sorry, I meant additive. Well, gaming is also addictive, but what I'm trying to say is gaming is additive. And what I mean by this is, let's just take a look at this chart on the left quite carefully. The black portion is arcade games. Well, we've all probably been to some form of an arcade. And you see, since the 1980s, really, there's been arcade games. And over the years, there's been a slight movements in revenue that's gone up a little, gone down a little. But 20 years later, 25 years later, in 2019, arcade games are still around. Has their revenue dropped substantially? No, not really. But the overall games industry has grown so much. It's because more games came in and they just added on to arcade games. They did not replace arcade games completely. Arcade games did not die. They just added on. And then console games, same thing. Since the 1980s, 1990s, until today, console gaming did not dip in revenue. It's just that PC games came on top and became popular. And today, mobile games. It has always been additive. It adds on one another. But the old kind of gaming did not die. They did not fully get replaced. And this is very unlike what we see in the music industry. Well, in the past, we had cassettes, vinyl. In my time, I recall Laserdisc. And today, all of that doesn't exist anymore, right? It's a very small part of it today is CDs. And of course, most of it has already gone digital. As you can see, in the early 2000s, cassettes has completely died. Revenue is zero. You don't see cassettes anymore. So I think gaming has been very additive, whereas something like music, the old technology dies and gets replaced. And why is gaming additive? To me, really, it's because everyone plays. I'm sure a lot of us here are familiar with some of these pictures. Pokemon Go. Pokemon was first published. The game was first published, Pokemon Red, in 1996, and in recent years, Niantic and together with Nintendo has kind of released Pokemon Go, an augmented reality game. It's been very, very popular. Look at the number of people on this picture on the right-hand side. In fact, there was one time personally, I ended work. I was near my office at Raffles Place. I was walking by and I saw this huge crowd of people. I thought, what happened? Maybe an accident or something. And I went closer and I realized that everyone was trying to catch a rare Pokemon. Look at the number of phones in this picture by this very elderly gentleman. Even an elderly gentleman like himself is playing Pokemon Go. 11 phones I counted on this picture. So everyone plays. Many people play games. And that is partly why gaming has been so additive. Actually, I find myself a bit guilty that earlier when I mentioned about this gentleman, if you notice, I used the word even. A senior citizen like himself was playing Pokemon Go. And that is because, I guess, in my mindset, I think many people tend to have this impression that gaming is for teenagers. Gaming is for teenagers, especially boys, perhaps, who plays games all day long. But statistics have actually shown us that this is not the case. Everyone plays. There are 2.5 billion gamers worldwide today. That is 1 in 3 people. And the gamer group and the gamer base continues to grow across different age groups and genders. In fact, by 2021, the number of gamers are expected to rise to over 2.7 billion, which is going to be over 30% of the world's population. And if we look at the diversity among gamers, it is not just concentrated in teenage boys. Really, it is concentrated in both genders, both male and female, men and women, girls and boys, as well as across all different age groups. Well, it is true that the largest proportion comes from men who are aged between 21 to 35. But it is actually quite an equal proportion between male and female, 54% compared to 46% across all age groups, even those between 51 to 65. Now let me introduce you to gamer grandma. Her name is Hamako Mori. She is based in Tokyo. She is 90 years old and she's an esports professional. She has got 320,000 YouTube subscribers watching her play games on a daily basis. I've watched her videos myself. She is very cute, very courteous. In fact, every day before she starts her video, what she does is that she says a very polite konnichiwa, followed by a bow. But don't be mistaken by that demeanor. Once she sits down in front of her computer, she holds her mouse and her keyboard. She is someone completely different. She is a professional Call of Duty player. She plays many, many games, and she streams her games real time on YouTube with 320,000 subscribers. So even 90-year-old grandma is playing games. And what is more interesting is that there are so many people who are interested in watching her play games. Which brings me to the next slide, which of course, all this playing and all these people watching gamers, it translates into money and revenue. And I was quite shocked to see this statistic when I was doing the research. E-games today is generating more revenue than the movie industry and the music industry combined. So the revenue of e-games in 2019 was 152 billion US dollars, whereas movies and music box office sales was 42 billion and music was 21 billion. So this is how powerful and how big the entire global e-games industry is today. And gaming in itself is transforming. Look at this picture over here. I show people this picture. Many of them tell me this looks like a concert. Well, it is not. This is the League of Legends finals in 2017 that was held in Beijing. There was a live spectator of 40,000 people. It completely filled up the stadium. Consumers today are no longer just spending and paying money to play games. In fact, they're very happy to spend money to watch other people play games. Gaming has transformed from just playing games to a form of spectator sport. It is today a sport in itself. It is a form of entertainment, and there is a growing viewership. This was in 2017. In 2019, in South Korea, the League of Legends finals, it was also a full stadium. They had a smaller capacity of about 20,000, and tickets were sold out in hours. So the 2019 sports finals viewerships. Let's compare League of Legends to NBA and Wimbledon. And this is the stats. It's really not just about playing anymore. There were 44 million people watching League of Legends viewers, compared to traditional sports like NBA with 15 million and Wimbledon of 10 million. Esports have grown leaps and bounds. And today, many people are watching e-games competitions, watching gamers play games on a regular basis. And I quote this from Forbes: Fortnite maker Epic Games is reportedly nearing a $750 million round at a valuation of about $17 billion, with many investors, including T. Rowe Price and previous Epic Games investors, KKR. And to put that $17 billion valuation into perspective, the entire National Hockey League in the US was valued at $21 billion, and all of Major League Soccer at $7.5 billion. Of course, this is the US League Soccer. This is not the EPL. But that is the difference about how esports has now really kind of overtaken many forms of traditional sports. Another picture. Now, this really is a concert. In fact, this is an in-game concert in the game Fortnite, which was developed by the game company I mentioned earlier, Epic Games. Epic Games is owned 40% by Tencent. So what this is here, really, I personally myself, I don't play Fortnite, but I read quite a bit on this. During the COVID lockdown period, they hosted this concert in game. So what Fortnite did, they invited American singer Travis Scott to come into the game with an avatar to host a concert. And in total, there were about 12.1 million people that attended in-game. 12.1 million. Again, to put that in perspective, that's double the population of Singapore. So they will all come into this island in Fortnite to attend this concert. They can't bring their weapons. They can't fight each other. And just to attend this concert. And to me, it's amazing. The graphics were amazing. The lighting was amazing. Every time the song changes, the lighting changes. And I just wanted to share this with everyone to give you a sense of the limitless possibilities that could happen inside a multiplayer game. I mean, we not only have people watching games now, we have people attending concerts in games. Who knows, maybe one day we will be hosting an investment seminar in a game. And with esports comes huge monetizing opportunity. With 150 billion global revenue, today esports revenue in esports itself is actually very, very small. It's only about a 1.1 billion. There is huge potential for growth. Most of it today comes from sponsorships, but there are many other revenue streams such as media rights, tickets, publisher fees, digital and streaming, which we expect to grow very much, that presents huge monetizing opportunities. And not only that, I quote Seth Shaw, which is the chief executive of casino management company Fifth Street Gaming and founder of Nevada Esports Alliance. He said, I expect that within the next 5 to 10 years in North America, esports will be the third after the NFL and NBA in terms of total wagering, i.e. betting. Some bookmakers have even seen increases in esports betting of more than 40 times during that time. And we know that a sport is a real sport when you see the gamblers and the punters come in. And this is already happening in esports. There is huge potential for growth. At 1.1 billion today in total esports revenue, we see this having very, very high potential. Sorry that this picture is not very clear. I kind of just ripped it off the internet. But I'm not sure if you see a familiar face. Standing right in the center is a Singapore-born singer-songwriter, JJ Lin. And who are all these people standing next to him? This is his esports team, called SMG, which stands for Still Moving Under Gunfire. So JJ Lin, being a singer-songwriter, he is also an avid gamer. And he has set up his own esports team. He has invested in this esports team since 2017. They do play various games across Taiwan and Malaysia. And very recently, he set up an all-Singapore team for the game Valorant, which is a first-player shooter game. And the next slide, again, someone who many of us are familiar with, Jay Cho, and his esports team, which he invested in 2016. In fact, he bought out the whole team. He renamed the team. They are based in Taiwan. And the reason I'm showing this is that I like to share with everyone that esports is not just some minor sporting competition anymore. Right? We have got celebrities backing it. We have got sponsors like Intel, DHL, Pepsi. Sorry, I'm referring to the column on the right. So this ESL is really the esports league. Sponsors include Intel, DHL, AT&T, Pepsi, Vodafone, Mercedes-Benz. These are major companies, major sponsors. And these sponsors are backing the esports league. So what does all this really mean? And how has gaming and the value chain of gaming evolved over the years. So firstly, in the past, I guess we remember Sim Lim Square. I would go down to Sim Lim Square and buy games. And games would cost me something like $40 to $50, or sometimes even more, each game, a computer game or a PlayStation game. And that's because of the retail-driven value chain in the past. You had your game developers, your game publishers, your distributors, your retailers, and then your consumers. And everybody in between, of course, takes a cut. But where we are now in the online value chain, effectively, we have completely eradicated these middlemen. You develop a game, you put it up on the App Store, consumers can download it straight away. And as a result, the game developers are able to generate a lot more return on invested capital, and consumers at the same time can purchase games for much cheaper than before. So all this together adds in to kind of why the gaming industry has such a positive outlook. And I'm also out of time, and this really comes to the end of my session. I hope I've given everyone a good background of the e-game sector. As a gamer myself, I've seen firsthand how games have evolved and grown over the years. I am personally a huge believer that as technology continues to improve and we have better internet connectivity, better processors, better graphics, we will see more games, new kinds of games, and more gamers. With esports on the rise, game streaming, which I did not have the time to really talk about, even game concerts, virtual reality, augmented reality, huge monetizing opportunities, huge sponsors, this sector will continue to grow. Thank you very much for your time and tuning in on a Saturday morning.